For part of the year, we literally saw people raising their price target to like 5,000 as we moved through the summer months. Boom, at that very moment, we started to see stocks weaken again. Can you just take us on a retrospective of how you think we got here?
Sure. The beginning of the year, our view was that we'd have a much worse second half than the first half because we thought we would see what we're starting to see now, weaker employment, take the Fed off our back. And so at the beginning of the year, what we saw was the banking crisis create a lot of liquidity, a lot of exuberance around AI happened at the same time. And that's where we really saw this market bifurcate, and the Magnificent Seven were born, effectively. And so if you've been watching the S&P 500, you've seen a headline index that's done quite well this year, as high as almost 20% by end of July. But if you're an active stock picker, or if you're not necessarily buying large caps, it's been a very different tape. So we've had this bifurcated market all year. And I think we have not seen a recovery trade persist for more than 2 months. And that's small caps, deep value, autos, retail, banks, because we don't have the conditions for a broad macro recovery right now. So I think what we're going to continue to see is back and forth between soft and hard landing, euphoria or fear, and much of the tape remained very bifurcated as the macro backdrop.
So until last week's jobs report, you'd have to say, wouldn't you, that employment has held up remarkably well. It's been pretty good. I mean, the month prior was a knockout number. Now it was downgraded. I mean, they took back some of those jobs. But until this latest report, employment's been pretty good.
It has been if you're just looking at, again, one of the headline non-farm payrolls number. And that was the 8th in the last 9 months we saw a negative revision. So what I look for in my process is not try to lean too much into one data point. Like non-farm payrolls or unemployment claims, but instead really look for a broad set of data that have historically given you warning signs to what perhaps we saw last Friday and what we may see.
Are you seeing those warning signs now?
We've seen them all year.
Yeah. What are they?
It's fewer hours worked in the manufacturing sector. That's been declining all year. Fewer temp employment. That's been declining for about 9-10 months consecutively. Fewer small businesses, NFIB data saying we're hiring. That's been declining. Consumers saying that jobs are plentiful. That's been declining. I could literally sit here and go on and name 20 different data points that have historically given you a warning sign. It's not telling you when a recession is going to hit necessarily, but it's helping you understand whether or not we're really in the midst of these lags of policy. And I think, yes, last week's payrolls report, ADP report, the continuation of rising continued unemployment claims, all fit with these other warning signs we've been seeing all year. And they're likely to get worse, not better, if we believe we still have much of the digestion of the lag of policy.
You're probably as familiar with the arguments about why we can have a soft landing or no landing. Goldman has been very bullish all along. They always had very low recession odds for this year. I think they're still pretty low for next year. They say maybe the labor market can keep going long enough to kind of get us through this rough patch. Do you think hard landing? I mean, is that not only that a downturn is coming, but potentially a severe one?
It's hard to know magnitude because, I deal in a very quantitative perspective, and you can't model what becomes a nonlinear event. Like when Lehman went bankrupt or when the tech bubble popped, we didn't know the magnitude of the downturn. That has to do with how much tightenings occurred, what the secular backdrop is. Too many variables to really plug in and have high confidence, more importantly, of the depth of the magnitude. What we could figure out is, are we heading towards recessionary data, or are we heading away from it? And I argue for much of this year, despite a lot of the headline data looking good and being very volatile, we've headed towards it. And
so forgive me for interrupting. The year-end target was 3,800, 3,850, something like that?
Yeah,
and you've stuck with it, to your credit.
We had, to be fair, we had a lower number to start the year. And I readjusted it higher in July, not because my outlook had changed, but because the market, the index, the 7 stocks that carried the market had gone up so much. I saw a stat today that maybe it's the top 10 stocks account for 134% of the market's gain, because the average stock, the equal weight S&P, is down this year.